Your income is the single most important factor in your ability to build riches, and we firmly think that whomever borrows must serve whoever lends to them. Plus, you can gain wealth through smart investment once you haven't doled out your hard earned cash to everyone else. If you start investing $500 when you are 30 and keep it in a good growth stock mutual fund until you are 70, you'll end up with nearly $5 million. Want to learn more on how you could do this one? Then you are in luck, because for today's video, here at Investing Path, we will be delving deeper into this matter, so make sure to stay till the end and hit the like and subscribe button while you're at it to stay updated for more of our content. Now, without further ado, let's begin. To put it simply, the quickest way to build wealth is to eliminate debt and put that money to work for you. Yet, for some reason, the financial services sector seems to ignore the importance of eliminating debt in favor of investing. Meanwhile, we find it incredible how many people work in the financial industry as financial advisors, writers, bloggers, etc. All of those people make their money off of the top 3% of the population. As a result, we started researching other investors' strategies in investing and how they diversify their portfolio. Well, the first step to that is to put your money into four categories of high-quality growth stocks and mutual funds, explosive expansion beyond borders, increased earnings potential, etc. When investing in mutual funds, we like those with a history stretching back at least 10 years. As a proxy for the stock market as a whole, an SP 500 index fund is the gold standard of index investments. As of now, our mutual funds have consistently outperformed the S&P 500, and finding them was surprisingly simple. It is not hard to beat the market, but we stick to funds that do better than average. On the other hand, keep in mind that if the mutual fund you are researching has a line that is lower than S&P 500, the mutual fund is underperforming the index. Do not purchase it because there is simply not much to it. Next is get some help with your financial planning from a friend or family member. When you are on your own on the evening news forecasting the end of the world, you cash out all your mutual funds in exactly the wrong time, even if the data suggests you'll keep investing if you keep doing that. Why? Because you have no one fighting for you. As an alternative, you are showing your feelings to the world. Investing money into mutual funds is the most important factor, since these statistics show that any portfolio of decently performing mutual funds will ultimately be successful. A recent study found that a high rate of savings was responsible for 74% of retirees' financial security in old age. How many of you actually contribute to your 401k plan each year, as opposed to just talking about it and never actually doing something about it? This is the path to financial success. For us, we have extensive knowledge of mutual funds and make most of my investment decisions, approximately 80%, based on the expected rate of return. We always try to find the longest track record if there is a tie for the fastest time. To put it simply, we are not a fan of taking chances. For us, taking risks means foregoing potential financial gain. Diversify the growth and income gains into four distinct categories: rapid expansion and across borders. Let us take a moment to discuss this, as mutual funds can have a wide variety of names, each of which indicates the fund's focus. Funds that focus on both growth and income are variously referred to as large cap funds, blue chip funds, or simply growth funds. Large cap is an abbreviation for large capitalization, which simply signifies that these are very sizable corporations. Your growth and income funds are the most boring of the four types of mutual funds I invest in, since they consist primarily of large, dull corporations with high capitalization. If you're going to track this volatility, we think this point is the most stable. Compared to the market, it is much more tranquil, making it a reliable ally at a tumultuous time. You now own this table. When things are improving, it is still dull and unexciting. As a stable land, it moves more slowly than the market up and down. A growth fund is the average investment vehicle. If you were looking for a growth fund, the one tracking the S&P 500 would be your best bet. Investing in expanding businesses is what a growth fund is all about. Because of their size, this type of fund is also referred to as the mid-cap fund. These are your basic mutual funds investing in growth stocks. The premise of the Central Growth Fund is straightforward. Mutual funds that invest in growth stocks and consistently exceed the S&P 500 index tend to be more volatile than other types of funds. Income funds can also provide growth, but their volatility is lower than that of the S&P 500. Then, there's the aggressive growth investment option. Many modern technological startups would be classified as micro-enterprises. All of the crazy, entertaining stuff is included, even if part of it inevitably fails and cancels out, making for a more chaotic whole. It is gonna be a lot more volatile than the stock market is, so it's gonna be quicker than the market goes up, but it's going to go down faster than the market goes down. You might also refer to the small cap aggressive growth stock mutual funds that are prevalent in this convergent market. In other words, the equities held by the international funds are not issued by the US firms. Its close relative is known as a global fund. Simply put, what do you see when you think of a globe? A global fund would include both foreign and domestic enterprises, making it a close relative of an international fund. Your foreign fund will underperform the other three options since American corporations tend to outperform their international peers as a group. A worldwide fund has consistently outperformed its international counterpart over the last several decades. Typically, you include some American firms, which are slightly superior because of your economy's reliance on consumer spending, but you also include some foreign firms, so at least you are not gambling on the American economy with no hedges. This is not about patriotism or nationalism on my part. Rather, it is about the importance of fostering a more inclusive society. You need some high-end BMWs and Mercedes-Benzes, of course. Even when some LG and other products are manufactured in the US, you still want them. The easiest way to diversify your portfolio is to invest in a mix of domestic and international stocks, bonds, and mutual funds. Foreign companies fall into this category. The point is, you should go ahead and do it. Investment is a topic that everyone seems to be discussing at length. The issue is that no one actually follows through. Everyone has an opinion. And the only opinion that matters is yours. So you have to take things slowly and methodically. Putting money into the market is the way to go. The only way to go, the best way to go. Growth and income expansion, aggressive expansion, globalization, not seeking high rates of return, and avoiding investments in areas of expertise are all sound policies. When people put their money into something they've been assured is beneficial without doing their own research, they are vulnerable to fraud. Have you ever read about how some famous NFL player or another lost tens of millions of dollars or burned through $100 million? They entrust it to another person and don't give it a second thought, only to be taken aback when they discover that that person is a dishonest swindler. That is a surefire way to have your savings disappear. It is your money. This implies you need to train it to act appropriately. It is almost as if you have to force your children to act well if you hope for them to turn out well. If you desire money, that's how you'll get it. This is the way things are going to work out. You have to comprehend it now. Having a master's degree in finance is not necessary to understand this material. Really, it is not hard at all. You just have to genuinely do this, and you have to comprehend what the money is going towards. So far, did these strategies motivated you further to invest? Or do you have other ideas in mind? Make sure to share your thoughts in the comment section below, and we'd be more than glad to share them. But other than that, thanks for watching. This is Investing Path. And if you like this one, make sure to hit the like, subscribe, and bell button to see more of our content about personal financing and investment news for you. Thanks again for watching, and we'll see you next time.